Hello everyone, I am Anna from MarketSmith India, and today's topic of discussion is using charts to time your selling. Time for disclaimer. The content in this presentation should not be considered as a recommendation to buy or sell a security. All information is intended for educational purposes only and in no way should be considered investment advice. Today we'll be broadly covering three main topics, starting with who Mr. William O'Neill is, what is the right time to sell a stock, and what are the rules to be observed while selling the stock. Well, it's important to know who Mr. William J. O'Neill is, and maybe then we can better appreciate his philosophy behind the sell rules. Well, he is among the top 20 greatest investors of all time. He is the man who turned $5,000 into $200,000 in just 18 months. He was the youngest of all to buy a seat on New York Stock Exchange. He is the founder of Investor Business Daily, the second most widely read newspaper after Wall Street Journal. He carried out a revolutionary study by studying all the biggest winners in their uptrend to find common traits in them, based on which he founded a very disciplined stock picking methodology known as CAN-SLIM. Well, to make money in stocks, you must also safeguard the money you have earned. So, the next big decision that comes after buying is when to sell the stock. Selling has been historically proven to be a tougher decision than buying, and this is where CAN-SLIM comes in very handy. It is a very practical and a rule-based methodology which takes care of the normal pitfalls of human psychology, also studied under behavioral finance. This philosophy is well studied, empirically researched, and has rules for choosing the right stocks, buying them during the momentum, and selling them at the right time. These rules bring in the discipline which is very necessary for every investor. So, based on his CAN-SLIM methodology, let's have a look at when to sell. So, let's divide our discussion into three scenarios where we would like to consider the decision to sell. First, when we want to protect our capital from big losses. Second, when we want to lock in the profits that we have earned. And third, when we see distribution, that is, general weakness in the market. Please remember, all these sell rules apply most effectively given our buying was within the ideal buy range as suggested by CAN-SLIM. So now, let's discuss them one by one in depth. This sell rule is specially designed to protect your capital against bigger losses. It has been empirically proven that winning stocks rarely fall below 8% of their current breakout point. So, if you have a stock that falls more than 8%, chances are the stock does not have in it what it takes to become a winning stock at this moment at least. Next, you might be wondering, what if after selling the stock it starts rising? Even if you sell at 8% loss and the stock quickly rebounds, that doesn't mean you made the wrong decision. You were just proactively protecting your portfolio. Taking a small loss from time to time is like paying an insurance premium to make sure you don't suffer a big loss. And you can always buy a stock back if it once again shows some strength. Now, let's have a look at an example to understand this better. So this is the weekly chart of Granules India. Here we can see the stock is consolidated and formed a cup with handle. These patterns can be automatically recognized in the MarketSmith India app. Now this is where the stock broke out and we suggest to buy. However, as we can see that this breakout was on low volumes and such breakouts are more prone to fail, and exactly what has happened here. Our selling point was 8% below this buyout point, which was somewhere here at 134, which coincides with this 50 DMA line. The stock in the coming days tumbled down to 91.45, which was 32% away from our selling point. So, if we exited at 8% loss, we could have avoided all of this mess. So, you see the importance of 8% sell rule. Well, the previous selling rule was to cut our losses. Now, let's have a look at when to sell when you are in profits. Now, let's assume we were able to buy a good stock at its ideal buy point and it's moving upwards nicely and giving us good returns. Now, at some point of time, we would want to lock in the profits that we've earned. We can either sell it when we see some weakness in the stock, which is known as selling on weakness, or we might consider selling it if it is having an extended run, which is not supposed to last forever, which is known as selling on strength. Let's take a look at the first situation, that is selling on weakness. Okay, let's discuss selling on weakness. Let's say our stock was doing a pretty good job up till now, but suddenly it shows some kind of weakness. This could be because of the general market conditions or some stock specific news. However, we the retail investors don't get the news as fast as the big investors, also referred to as institutional investors, do. And that is because institutional investors have a large position in the stock, which brings to them automatically a higher risk. So they have more resources deployed to track the company more closely and get the news much faster than us. But hold on, there's still a way we can find out what these big investors are doing, and that is by observing the charts closely. So let's study those signals in detail. The key thing here is institutional selling, that is selling on large volumes. This is the volume chart. The red line that you see here is the average volume line over the past 50 days. So these red spikes that we see here all over this, these are selling on heavy volumes, which we need to be careful about. It is a big indication that the big investors are dumping their shares. Okay. Another sign to be watchful is when the stock breaches its key support levels like 50-day moving average. The red line that we see here, this is the 50-day moving average, and the black line that we see here is the 200-day moving average. We see the stock, it has breached this 50 DMA and later 200 DMA and performed badly after that. To know more about 50 and 200-day moving averages, please watch our dedicated video on this topic, which will take you through the entire concept in much detail and with several examples. Okay. One more indication is gap down. If a stock gaps down sharply on heavy volumes, that's another sign that big investors are losing the conviction in the stock. Now, let's have a look at this example to understand it better. Okay, so this is the daily chart of Granules India. All these charts can be very easily pulled out from the MarketSmith India app on Google Play Store. So here, as we see, this red line is the 50-day moving average and this black line is 200 DMA. So the stock has breached this level of 50 DMA with heavy volumes. So this indicates that the big investors are dumping the stocks. So this is a big indicator for us, the retail investors, to be cautious about. And as expected, after that, the stock has really performed badly. Here we can see a few gaps down. This is the first gap down on heavy volumes, and this is the second one again on heavy volumes. Okay, let's have a look at another example. Okay, so this is the weekly chart of Asian Paints and this is the daily chart of Asian Paints, again pulled down from the MarketSmith India app. So here we can see the stock has breached this 50 DMA on above average volumes. So after that, the stock has really fell down. To look more closely, let's have a look at the daily chart. Here again, we can see the stock has breached this 50 DMA line on above average volumes, and after that it has corrected so much. So if we cut our losses somewhere here, or let's say booked our profit somewhere here, it could have saved us from all this trouble. Now here is yet another situation wherein we did everything right. We did a full research, got the right stock, pick it at its ideal buy point, and it is continuing to do exceptionally good over a long period of time. Wow, looks like we finally nailed it. But do we think the stock will continue to go up higher and higher and higher forever? Well, sadly, the answer is no. So now, when everything looks hunky-dory, when do we sell? Well, simple rule is to sell a stock when it rises by 20% to 25% after the ideal buy point. Our researchers have shown that the good growth stocks tend to advance 20-25% after the breakout of a proper base and then pull back and consolidate for a while to form a new base. So, after a significant advance of 20 to 25%, sell into the strength before the stock pulls back and you stand a chance to lose your hard-earned gains. The rule of 72 will show you why booking profits at suggested levels of 20 to 25% is healthy. So let's see the rule of 72. So how it works. Take the percent gain you have in a stock and divide 72 by that number. The answer will tell you how many times you will have to compound your gains to double your money. Let's say you have 24% returns. You will have to get at least 24% gains 3 times, reinvest your portfolio each time to nearly double your money. Don't you think the probability of the stock to maintain the same pace over the long period is less? And isn't it much easier to lock in 20 to 25% gains in 3 different stocks than to gain 100% profit out of one stock? Those smaller gains still lead to big overall profits. However, there is an exception to this rule of 72. If a stock rallies 20% or more in the first 3 weeks of an ideal buy point, keep the stock for a minimum of 8 weeks to reap the full benefits of the run-up of the stock. This could be a potential big winner. Another signal is climax top. If a stock is 70 to 100% above its 200-day moving average, it is quite extended and may be hitting its climax top, where a stock will move straight up for 6 to 8 days and finish off with one last gap up, which would be the exhaustion gap. This is a sign of weakness. This sell rule, like the others, is meant to get you to start looking at other signs of weakness in a stock. Climax top mostly happens after the stock has announced a very lucrative stock split. Now, here is yet another situation wherein we did everything right. We did a full research, got the right stock, pick it at its ideal buy point, and it is continuing to do exceptionally good over a long period of time. Wow, looks like we finally nailed it. But do we think the stock will continue to go up higher and higher and higher forever? Well, sadly, the answer is no. So now, when everything looks hunky-dory, when do we sell? Well, simple rule is to sell a stock when it rises by 20% to 25% after the ideal buy point. Our researchers have shown that the good growth stocks tend to advance 20-25% after the breakout of a proper base and then pull back and consolidate for a while to form a new base. So, after a significant advance of 20 to 25%, sell into the strength before the stock pulls back and you stand a chance to lose your hard-earned gains. The rule of 72 will show you why booking profits at suggested levels of 20 to 25% is healthy. So let's see the rule of 72. So how it works. Take the percent gain you have in a stock and divide 72 by that number. The answer will tell you how many times you will have to compound your gains to double your money. Let's say you have 24% returns. You will have to get at least 24% gains 3 times, reinvest your portfolio each time to nearly double your money. Don't you think the probability of the stock to maintain the same pace over the long period is less? And isn't it much easier to lock in 20 to 25% gains in 3 different stocks than to gain 100% profit out of one stock? Those smaller gains still lead to big overall profits. Our last topic of discussion is general market condition. As it is said, never swim against the stream. The same applies to our stock markets as well. There is a full-fledged mechanism developed by Mr. William O'Neill to understand the current state of markets. Please watch our dedicated videos on them to understand in detail. In brief, weakness in markets can be hinted by observing the following. First, distribution days in key indices. A distribution day is when the index closes at least 0.2% down from the previous day's close on heavier volumes. This is a sign that institutions are unloading their shares. Second, 3 out of 4 stocks tend to follow general market conditions. So, when majority of the stocks are falling, the probability of our stock going against the market trend is quite less. It is then better to book our profits than just letting the market to wipe them off. We can always re-enter later when market and the economy stabilize. Third, always know where you are in the market cycle. If you don't know where you stand in the market rally, making smart decisions is trickier. It is normal to have an intermediate market correction of 10% to 12% after the first year of a bull run market cycle. So let's summarize whatever we have covered and learned in today's session. First, protect your capital from big losses by cutting your losses at 8% from the ideal buy point as suggested by Canceling methodology. In case of profits, sell when the stock observes weaknesses like big price declines on heavy volumes, breaches key support levels like 50-day moving average, or gaps down on heavy volumes. Know when to take your profits off the table. After the stock has gained 20 to 25% from the breakout, please book your profits by applying Rule of 72. Another signal is climbing stop, that is, when the stock is trading 70 to 100% above its 200-day moving average. This means the stock is quite extended and maybe now is the best time to book the profits and get out of the stock. And last but not the least, know the current market outlook and never swim against the stream. That's all, guys. Thank you for watching this video. I hope we all learned something new today. Please feel free to write us back in case you have any queries. We'll be happy to address them. Also, to know more about us, our model portfolio and the market conditions, please download MarketSmith India app available on Google Play Store.